It's 8:30 in the morning on the west coast of the good old US of A. Still the US of A, not the Socialist States of America, the SSA, not yet at least. And maybe the market's starting to realize that there's some potential for change going forward, but we'll get to that. I got Dr. K, you there?
How's it going? All good.
Okay, all good. And we even have Ross Haber on the line, so if any of you want any of his insights, feel free to IM, and I'll see if I can drag him onto the line. He is listening. But, Ross is joining us, as you all know, and Ross is a very good trader himself. I can tell you one thing. He has run more money. He has run bigger hedge funds than Dr. K and I put together, and even combining all the different funds that we've run separately and together. So, he knows what he's doing. So we're happy to add him to the team. And the one strength about adding someone like Ross to the mixture of Dr. K and myself is that we pretty much revert to how we were at O'Neill. O'Neill was a unique environment that we all supported each other, and we shared ideas and research, but we didn't interfere with each other. And it's a very unique mix that way. And so it was very productive and a very unique environment for us, and I think we're emulating that today. But anyways, Ross is there, so if anybody has any questions, feel free. Let's just start with the market here. You can see the NASDAQ's coming up to resistance up here close to 2750 level. It's working its way higher, and there's really nothing here that I can say is necessarily. I mean, we tried being short, and the one way you can tell you're not going to make any money shorting is you get blown out of your positions pretty quickly. So you stick to your stops and you take the information gained thereby, namely that nothing is really working on the short side. While you do see resilient strength in names on the long side, you can start to shift towards having a little more of a long bias. So I don't know if you can go hog wild necessarily. Things may take longer to develop. The one thing about this market that strikes me, and what I want you to do is I want you to look at this chart of the NASDAQ composite here. And you can see we have this big break in August, very quick break, and market chops around, comes back, tests a low here in the middle of August, towards the end of August, and then rallies back up and then undercuts the lows. At this point, everybody thinks the market's going right down to hell in a handbasket, at which point you get this very sharp rally off the lows, back above the 200-day moving average, where you go back and forth. Then you break one time, looks like you're heading back to hell in a handbasket, but no, you turn around, you gap up, back up to the 200-day, chop back below the 50-day, and then back above the 200-day. And we get a lot of emails and people saying, oh, this looks like 2008, this looks like 1911 or 1848 or whatever. But you know what this kind of looks like to me is 1994. And this is the chart of the NASDAQ in 1994. I'm using my high growth stock investor software, which I like. I think it's one of the best low-price solutions out there. They also have, by the way, pocket pivot screens embedded into their system, just for those of you who might be interested in checking it out. But in any case, this is the NASDAQ in 94. You had a big break in February. I remember it well because back then the big theme was the hunt for yield, and a lot of people were heavy in bond funds. Bonds were doing pretty well. And back then you were starting basically the secular decline in interest rates that continued throughout the 90s. And of course, has reached an extreme today where you're running close to 0% interest rates. I even think that the other day German bonds sold at a negative interest rate. So we've come a long way in terms of interest rates since the early 1990s. But I remember when the Fed raised rates in February of 94, the market broke very hard off the peak. And if you look at the chart of the NASDAQ, you can see here's your break off the peak here. So I don't know, let's see if there's any way I can put these together. And we'll squish them together here. There we go. Take that one like that. And let's see if I can take this one over here. Kind of squish it down here. Where are we right now? Let's see. And yeah, this kind of gets it, more or less. Let's go back. And what you can see here is here's a break in February. You notice how you came down and you tested a couple of times. You made a sharp move down into the lows, and then you undercut here back in the middle of 1994. And that's very similar to what you had going on here. Then you had this big move here, and this corresponds to this move here. You got back above the 200-day, and you flipped around for a while, back and forth around the 200-day before finally coming down again. And then he started the big new bull market in 1995. So to some extent, I wonder if that isn't what we're seeing now. Maybe this will resolve sooner. But it is similar in that 94 was a very mushy, sloppy, choppy year, and that's exactly what you have had going on for the last 12 months, maybe a little less than that so far coming into January of 2012. And so you're just kind of in that environment. But it seems to me that it's slowly but surely starting to set up here. And I'm long this market here. I was playing the short side earlier in the year, had a nice move the first couple of days, but of course we were joking about being 10, 11% up is almost nothing for us. And so we're back to the flat line here and a little bit below, trying to come back after getting stopped out of shorts. But that's pretty much the way we play it. And so the information that I gained by having myself stopped out of shorts, and steadily we've been seeing stocks like Apple, Amazon, things that we've been trying to short. You're not getting a lot more downside, so it's kind of like pushing on the string. So you can start to feel that. And as you're feeling that, you just start to shift back to the long side. So right now the market acts okay. And one thing I think you need to keep an eye on here, let's see if I can find my other weekly chart. Let's look at the NASDAQ here. Whoops. This guy's floating. Okay, hang loose here. We're getting there. We're getting okay. Now here's the NASDAQ, and what you're noticing here is that you're getting a little bit tighter in these ranges, and that's something that you haven't seen for a while, because notice how the weekly ranges on the market chart here have been pretty wide, so it's starting to tighten up just a little bit. If this continues, then it's beginning to look more and more constructive and less like it's going to break down, but we'll see what happens here. But that's kind of where we're at in general. Now, Dr. K, what would we need to see to go to a buy signal on the model?
Well, essentially, we need to see continued constructive action in leading stocks as they trace out their basing patterns. And, of course, it would be nice to see a traditional follow-through day accompanying that as well. But that said, you don't always have to have a traditional follow-through day. If you get enough leaders that are showing constructive patterns and issuing pocket pivots, that's enough of a buy signal. And a good indication of that would be in April of 1996. I started buying stocks even though my model stayed on neutral. And again, it's one of my rules. I don't care what the model says. If I see stocks that are buyable, I'm going to buy them. And these were top leading stocks. And then the model eventually, I think about 2 or 3 weeks later, went to a buy signal, a traditional one. If you look at the actual chart of the NASDAQ, you'll see why. The NASDAQ wasn't really doing much of anything. It was going sideways. And then we had a traditional follow-through day. The model went to a buy. But about 2 weeks prior to that buy signal, there were enough names, including iOmega, that did well, that broke out of basis. And so,
what year was that, Dr. K? What year was that?
96.
1996.
March, well, April of 1996 was.
So that would have been right in here.
Yeah, so you can see that the market wasn't really doing much of anything until mid-April, and then you had the traditional buy signal on the model out of that basing pattern on the NASDAQ. But top quality names actually started breaking out in late March and early April, and that was my tip-off. And actually, I mean, this is of course in hindsight, but there are some the model's systematic, but it does account for material changes in the market. And so one of the rules that is implemented now is if we do get enough constructive patterns that are breaking out, and the model still says it's traditionally neutral, the model will switch to a buy signal on that basis, because the odds are that the rally will continue.
Mm-hmm. So anyway, so what we're seeing here is a couple things. I'm just going to go through the, getting blown out of the shorts, and this ran up into resistance here, and it's pulling back. But notice the selling isn't really heavy. So to me, it seems like a lot of these are played out on the downside, and it's going to depend on what happens on earnings. If something exciting occurs, these things could gap up or they could get hit. And I'm going to give you a good example of why the short side is often dangerous. Yesterday, I've been short this one coming off of this peak here, and as it came down, it's been working. I've been trying to work a position on this thing. And you had a couple of buy recommendations over the last week that sent the stock higher on increasing volume, but it never got above the 20-day moving average. And then yesterday, I went off to the restroom for a few minutes, and normally I have the flat panel screen in the restroom on, and I'm not going to get into that. Other than that, I didn't have it on this time when I went in, and I couldn't see what was going on. And I come back to my desk, and the fossil's gone from like 81 to 84 and changed, and I'm getting blown out of it, so I cover my position very quickly. And just don't argue with it. You know, you can sit there, but I think if you were on the short side, the market's showing you that you can get hit pretty good. And when that starts to happen, it's telling you that you're better off trying to linger on the long side. And so this morning, you had a nice pullback in a number of names that I think act pretty well. We like this little InventSense. I think this is the Omnivision Technologies of the new millennium, or actually the 2010s, I guess you might call it, the 20-teens. And the thing that'll drive you nuts about a stock like this, you see it come up. We told you about it right here. So buying it under 11 puts you in a good spot right in here to pick up some shares. Then it breaks out to a new high here. And this is a short base. And it just continues higher. Now it's extended, but it wouldn't surprise me if you saw this thing holding very tight. So I keep an eye on it here. Maybe the 10-day needs to catch up to it. But, you know, I think you just sit with it for now because I don't necessarily think it's going to come back in. And you notice today it's not coming in. The market was down this morning pretty good, and it held in. That struck me because it's a pretty thin stock, and usually if the market's that weak, the thinnies come off the hardest. And that didn't really happen. So the other one that we like here, and we notified you all of the pocket pivot on this day 5 days ago, is holding up very well, and you're getting a nice little pullback. It even looks viable coming into here with the idea that it should hold the 10-day. What you might notice is that it has, since this point here, where you got a little, you might call this a little weird pocket pivot right here, since then it's held the 10-day moving average. You'll notice it did close below it, but here's the intraday low of this day, and it has never moved below that low, so technically it has never violated the 10-day moving average. Now, as you come in here, you can see it tries to, but it never really closes below this low here, even though you're close. So it tends to hold the 10-day, maybe a little bit of porosity around there, but I would think if it pulls in, it's got to hold this 1488 level around the 20-day at least. I mean, it's a little bit thin, so you know, it may need more time, but that looks pretty good, and it's a pretty good story with that one. So the other ones that we've been looking at, QCore, of course, is the one that gets a lot of questions, and I think this is interesting. And I'm long this thing. I bought this thing this morning closer to 35, mainly because I think this investigative report might just turn out to be a bunch of BS. It strikes me as a little bit shady to short 80,000 shares of a stock and then come out with a headline that says, next week we're going to come out with a 2-part investigative series on QuestCore's sales practices. And I think that's kind of interesting. Why not come out, why not announce it all when you have the stories and you have some facts to marshal behind it? So it seems interesting. What I'm watching here, I think this is a clean trade with the idea that it should hold this low here, because you basically come in, you fill the gap. Now, O'Neill would say if you have a stock and it gets hit like this on some kind of news, you give it 2 or 3 days, see if it rallies. So that's kind of how I'm playing it. But this is a trade. And technically, you know, you would say that something breaking like that, that thing's done, but this could end up being a huge shakeout in the stock caused by some BS news. So we'll see what happens. But for me, this is a trade. For all I know, I'm just taking profits, you know, a buck or two up on a bouncer. But we'll see what happens. I may hold, if I get a profit and a little bit of a cushion in a bigger position I'm running today, I may decide to hold a small position and see what pans out next week. But you know, this is kind of a weird thing. You do have this gap up, and we mentioned that, but you notice the next day it breaks the low of that gap up base. So if you did buy this, you should be selling it. The other thing I don't like about this is the gap up occurs too soon. So you're basically straight down and straight back up. It's not really coming out of any kind of consolidation pattern, and it's not going to new highs. You know, that's similar like what you saw with Lulu. Oh, I think this is a good move, but you're not clearing out to new highs, so you are going to have some overhead resistance. It may take a little bit longer, but there is some porosity around this low. And one of the rules, Dr. K, don't you use a rule where you say you add 2% to the low for a stock that might be a little more volatile?
The 2% is just a rough guide. It really is kind contextual to the ATR of the stock, or
Right.
rather the volatility of the stock. So it's kind of a rough guide. A lot of these top quality names tend to have relative strength above 90, and especially after gap up. And so, I find in practice that generally 2% is more than enough porosity to give a stock. But I also factor in the general market. If the general market is weak for a couple of days, let's say it has a temporary pullback, it might drag these stocks with it, and so I'll allow for that as well.
I see. The one that looked pretty good was Tractor Supply, gapping out, and it actually moves higher. Now notice this came out to a new high, and the volume was tremendous here. So this one's a little bit better, but you're pretty well extended from the intraday low. But those look pretty good here. Let's go through some other names. Alexion, I think, looks great. I think the fact that you're coming out of an okay base here, it is a little bit of a volatile name, but notice how it's holding the 10-day after the breakout. And I think if it comes in, the breakout point here is about 70.5. So if you're at 74 or below, I think it's very viable on pullbacks here. You're within range with the idea that it should hold a 70 level. So actually own this turkey, and hopefully it'll continue going higher. But they did have their drug Soliris approved for a second therapy for AUHUS, I think it's called. All these things have acronyms like PNH, paroxysmal hemoglobinuria, or something deficiency. I forget, but they're very complicated names for rare diseases that these drugs, or this one drug they have, treats, and so it just got approved for a second use also in Europe. So I think what that drives is maybe another wave in the product cycle, and it's certainly showing that by breaking out and holding up pretty well. So, and among the biotechs right now, it's probably the strongest one, along with SPPI. If you look at Salix Pharmaceuticals, ever since we alerted you to the viable gap up here, it's just continued higher. And last week, you guys might recall, we saw it on this day. It was coming off the 20-day. I suggested that you might take a position there using the low of this day as a very quick stop. So when it pulls down like that, your risk proposition is very low. You can come in and step in and buy a position and then dump it with very minimal downside if you're using this as your stop, plus 2% or however you want to handle it. But notice how it's just continuing to higher highs, and new highs actually, and it continues to act well. So Jazz was the big viable gap up here, and it went higher. So you're pulling back right on top. Looks like it might take some time for the 10-day to catch up. Maybe addable if you bought some shares in here. Maybe addable into the 46 level, coming back in. So we'll see what happens with that. But that's an example of a gap up here that had some overhead, but it just plowed through that. So it might be a little bit better position, given that you were going sideways here, whereas with Lulu, for example, you're already extended off the lows, so you're kind of gapping up after a move rather than gapping up out of a sideways position. Tractor Supply is also gapping up out of more of a sideways position, so I think those tend to work a little bit better because they're not so extended. But we'll see how they go for now. But I think Jazz looks okay. You also notice these little triangles here. These are ants. We have the file downloadable off the website. It's an EFS file for eSignal, but it basically puts these little triangles on top of the daily bar on the bar chart whenever the stock is up 12 out of 15 days in a row or better, which is usually a sign of strength coming up out of a base. And the way we used to use this rule back at O'Neill is that when you had these and then the stock pulled back for a few days, when it turned around and went at the top, you could really lay into it. And of course, these types of setups that I really like, and that would work. I find that it doesn't work so well these days. So that's really more a function of the markets. You don't have that sustained strength like you did in the 1990s when we actually began our careers. So anyways, what else? Let's look at gold. Somebody asked us to talk about the Black Cross in gold.
Yeah, I can answer that one.
Well, there is no Black Cross because the 50 days of blue line here.
I just wanted to say that there's an issue with that question. When someone's asking that kind of question, they should know that their focus is in the wrong area. In other words, you're trying to anticipate something that hasn't happened yet, and you might as well do that for every single stock, and you could waste a lot of time doing that. You should focus on the present, what is showing you viable or potential opportunity now, rather than worrying about something that hasn't happened. And GLD the 50 days still a ways away from the 200, and it might do like it's done before, where it doesn't quite penetrate it but bounces off it. But we also have periods of GLD. For instance, if you go back to 2006, for instance, and you can look at September 2006, actually October 2006, you had a black cross. The 50-day crossed under the 200, and it didn't mean anything.
On the GLD?
Yeah, GLD. If you go to 2006, and you go to October. And essentially, and you also had in early 2005, you had a black cross, but that didn't mean anything. The GLD was in a basing pattern, and again, I don't like to guess where the market's going to go because there's a lot of variables.
There's a black cross.
Yeah.
Right there.
And it doesn't mean anything because GLD was in a basing pattern, and that's all it was. And from the looks of things, and given the fundamental backdrop with QE and all this money printing that is occurring and will continue to occur, GLD should be tracing out a basing pattern. So I think it's a matter of weeks to potentially a few months before GLD is ready to break out of a solid base again. But it probably will, because it's been doing that since 2001, and again, the fundamentals haven't exactly changed. In fact, they're more in favor of hard assets, including precious metals, moving higher in price.
Right. And you're seeing commodities starting to act much better coming off their lows. And I think the bottom line is that governments are going to continue to print, and the Fed is talking about getting into this buying up mortgages, mortgage-backed securities, in order to pump more liquidity, and it looks like that's what's going to happen. I think the Fed may be willing to give it another try to come in with QE 3 or 4, whatever it is, because they may feel that this time they'll get a little more traction if there are some more positive economic policies coming down the pike after the election in November. So that's a possibility, and it seems like the market is telling you that, even though it's still a bit choppy and still a bit sloppy, but it could slowly be setting up. So you don't want to get yourself locked in one way or another into having to be bullish or bearish. I hear people, oh, these are the reasons to be bullish and these are the reasons to be bearish. I mean, what's the market really showing you? And to me, it's not really showing you much progress on the bearish side. The setups that came and went in October, Netflix and Green Mountain were really your big scores on the short side. Amazon actually worked out pretty well, but it may be on the low end of its pattern for now. But that's, it's giving you real-time feedback. And so if I start making some money on the short side, now I have a cushion. What I'll generally tend to do is I'll use that cushion to get more aggressive and to press my advantage. Now, if I start to do that and the market whips back on me, I get hit, I lose my cushion, but I also get some information. I don't get ticked off because I lost 10, 11%. That's peanuts to me. But what I do is I then kind of shift back and say, okay, the market just showed me something. And how am I going to use this information in terms of what it did to me in real time, or what happened to my positions that I was trying to play on the short side? And I use that information, and I've done that with great effect in the past. And some of the biggest successes I've had come after just an episode like that, where you get pushed around a little bit after having some initial success. And a lot of people, they'll make some money, 10, 20%, and they'll see it disappear or get whittled away as the market doesn't sustain in the direction that they thought it was originally going to go in. When they started making money, you get ticked off, you get sidetracked with your emotions, rather than taking the information for what it is and understanding that it's telling you something about the market that you can use to make money, potentially, rather than wallowing in whatever, you were starting to make money and you didn't make money or whatever. So that's the one thing you really want to keep in mind. Is that focus on what the market's telling you, even when you are wrong and you lose money on a trade, okay? And get out of this feeling sorry or projecting anger towards others for losing money in the market, or whatever you do to emotionally get carried away with yourself. Some questions here. Any news from Ross? Well, Ross, let's see. He just got back from Milan. And what other news? So I think he just added a couple new guns to his collection. What other news did you want to hear about? The Managed Accounts program, we're still putting it together, so everybody's just going to have to hang tight there, and I won't answer any questions there regarding that in this forum for now. There do not seem to be enough pocket pivots, 50, etc., for me to get quickly concentrated. What buy rules were you using? on what? We just, I mean, we don't sit there like we're running, at least I don't sit there and say, oh, I'm up 2%, I'm going to add 2%, up 2%. Why is, if I see a trend developing, I just jump on it, and I go after it full board generally. And I've used the example, somebody's asking a question, you guys get concentrated very quickly, what buy rules are you using? Well, we're definitely not using the low octane buy rules, but the things that, the way I trade at least, and I know Dr. K, when he averages up, he's more aggressive than adding 2%, every 2% up or whatever, however that works. But I constantly go back to this example, and making big money, at least from my perspective, is not about sitting around with little positions in stocks as they go sideways, waiting around for something to happen. It's waiting for the window to open wide and then jumping on it. And I'll go back to, I love to use this example. Time travel is difficult here, so bear with me as I go backwards. I love to use this example, on Apple, and you can buy your little positions in here, and you're slowly building your little position here, but I go from here to like all the way into this thing on this day right there, and that's what I'm looking for. I'm not really, stuff is nice, I guess, and maybe it works for some people, but that's how I do it. And Dr. K, how do you get quickly invested? What circumstances will cause you to become very rapidly invested, such as we got in late '99?
Okay, well, an example would say be September of 2006. It was the first time since 2003 that I saw so many excellent patterns setting up and issuing pocket pivots. So I found myself in 3 days from the buy signal completely margined out, 200% long in the market. And so the process happens very quickly. I just saw so many high-quality names, and I typically would buy, in less certain environments, I might only buy 15% starter position. But in this environment, much more robust, about 25%. Well, first I started 12%, 12.5%, and then I moved it up to 25% because I saw so many new names coming through. So it was the first time I saw a real window open since 2003. And then I continued, with being 200% long, it felt like being in the 90s all over again. And for the next 3 months, the market had a huge, nice rally, and these names carried with it. Some of these names I would sell out the weak ones that, for instance, violated their 10-day and move that money into a new stock that was breaking out or issuing a pocket pivot. So those 3 months were very profitable, where my count went up about 115%. And that was the last time we had a 3-month. The last time we had a 3-month window on the buy side was that period. That was it. We had a 2-month window in 2007. And I'm talking about the general market. Of course, there were some individual names in 2007 that continued to move. I think Baidu was a great one. But in terms of the overall market and being able to play, say, 8 names or more in one's account on full margin, the last long period was 3 months in 2006.
I remember '99 getting very quickly and heavily invested into Oracle. And one of the ways that I caught this last move here is, you see the ants? They're the ants again, telling you you're up out of 12 out of 15 days or better, or 13 out of 15 days, or whatever it is, in a row. And what happened is, you got the ants here, you pulled back one day, you came out to new highs, I bought. You got the ants, you pulled up for one day, pulled out to new highs, I bought again. Here you got the ants again, and you pulled back, and this actually turned into a little mini ascending base, formed this little cup of handle, and when it started here, I was all over it again, going into the last couple of weeks of December. And I remember being, in early December, being up like 300, 250, 300%, and some of the other portfolio managers telling me to take my profits and bag it, because back then we made 10% of the profits, and that was a lot of money back then. And nope, I mean, I could see it was just going to play out, so I just held it right into year end, and actually ended up 520%. So, it just goes to show that just go with the trade, and it'll start to work. Now, right now, in one account I'll be very heavy invested as I'm testing things, but I keep very tight stops. It doesn't mean I'll stay with anything necessarily, but we haven't really had a trending market, so it seems like you get these general bursts one way or the other, and you trade them for a few days, and that's basically what you're doing, is swing trading. If we had a much more concerted trend here, we probably get a lot more invested and sit there. So in a good trending market, we get long under the right conditions, and we'll stay on margin overnight, whereas in this market, I'm very wary of staying on margin overnight. or having big positions overnight because of the various gaps either way. So.
Yeah, keep in mind also when the market's not trending, you're going to have a lot of false starts, and the idea there is to minimize your drawdowns. So you might go, in a situation like this that drags out, you might go 9, 10, 11 months with no profit, where you're up a little bit, down a little bit, and you just keep going back and forth, and it kind of wears you out. It will, it wears a lot of people out. But the idea really is to have the 30,000-foot view and to know that the market is going to make a move in one direction or another eventually. It doesn't just stay in this trendless pattern forever. At least it never has. So, just keep knowing that there's going to be opportunity down the road.
Somebody's asking about silver. There's nothing different about silver relative to gold. It undercut this low, and it's trying to come off its lows right now. So there's really nothing there. We're watching gold as really the leader among the two metals, and really the one that will probably lead the trend whenever it occurs. So we don't really have much to think about it. Somebody's saying discuss. Oh, here's a quick question. How do you get 400% invested in stocks? That's on an intraday basis. You can use 4 times your buying power, or 4 times your equity as buying power on an intraday basis. But overnight, you got to get back under 200. That's how. Discuss sector performance versus market and stock performance. Discuss sector performance versus market and stock performance signals. Dr. K, what is that?
Well, I think they mean in terms of industry groups. You have, these long-term studies we've done, and this was started by O'Neill long ago, showed that a good part of the stock's move is due to the industry group it's in. So, in other words, if it's in a top 10% or top 20% industry group, it's got a lot of wind at its sails. It's got a lot of good tailwinds that could help it higher. But obviously, you want to be invested in the best stocks in the strongest industry groups is what we like to ideally recommend. Once in a while, you're going to get a stock that's exceptional and it's in a poor industry group. But the rule there is you want to see at least one other stock that confirms the strength of the stock you're thinking about buying, and then you can go ahead and buy it. So yeah, industry group strength, sector strength, that's all, it's all very relevant. And sometimes you get also the general market's weak, but you're going to see, for instance, in early 2011, general market was weak, but precious metals were on fire. So the precious metals sector was investable and pyramidable.
Let's see. Somebody's asking about if you bought INDN on the pocket pivot, wouldn't this be a good place to take profits? I guess as long as it doesn't go higher. If it continues higher and leaves you behind, then you screwed up. But I think if you bought it here, I think you got to give this a chance. Dr. K, you got any comment on that?
Yeah, that's where that's where my sell rules come in very nicely. I don't have to. I hate selling in the strength. I don't think I very rarely sell in the strength unless it's a clear climax move, and climax tops are very rare to begin with. So in general, it's my trading personality to want to sell on weakness, which means a violation of the 10-day, or if the stock has a high volume reversal off the top, that's a gift, because that sometimes allows you to sell at the very, on the very peak, of the run. Or if the stock has a nasty gap down, and by the nasty gap down, I mean it might gap down 4 or 5%, so nothing like a 20 or 30% gap down, but something that's telling in the pattern that says, okay, there's a high volume gap down, and the stock's now off 4, 5, 6%. Maybe I want to sell at least half the position here.
I love this one. So, Gil, would you suggest buying a position in QCore? What, do I have to do your thinking for you? I told you what the parameters of this trade are, and you want me to tell you, yeah, you should go and buy it. No, if you want to buy it, go ahead. But the parameters for this trade I have are pretty clear in terms of what I'm looking for. I'm not making a recommendation one way or another. And if you need someone to tell you to do something without you thinking through the trade, so in other words, if you buy it here, where's your stop? I think the low of the day probably works pretty well, or you could use this low, or you could give yourself a time stop, depending on how you want to handle it. But I'm not telling you to buy it. I know what I'm doing, and if you're just going to be blindly looking for someone to tell you what to do, you shouldn't be in the market. Particularly with stocks. If you're using the market direction model to do the ETFs, that's fine. But stocks, you take your trade based on the parameters of the trade, and and operate thereby. You don't buy things because somebody says to buy it. Silliness.
And always know your exit point with everything.
Exactly. So I mean, this is a little bit of an unorthodox trade. So people ask me about oils. I like Continental Resources, but as Dr. K likes to say, oils are 3 steps forward and 2 steps backward, and that's kind of what you see here. They move up, they pull back. So if you like CLR, I guess this is where you buy it. If you like oils, I tend not to like oils. We put this keg on, we put it out as a pocket pivot, but that thing's done right away because it should have held this gap. And that's pretty cheesy. Now, I understand Jim Cramer was recommending it. Maybe that's what caused this. But I got to say, the numbers aren't too bad. So I don't know. Dr. K, would you buy this pullback, or in your view, is this thing just failed outright?
Oils are really sloppy, and I tend to not like to trade oils as a general rule.
Yeah, same here.
You get one-offs like 1997, you had all these oils moving to the upside.
Yeah.
But then that was a concerted group move off clean patterns, so it was tradable. But that's pretty much the only time I've seen so many oil patterns launch in the space. And this is not one of those times. I mean, commodities are probably going to head higher over time, and oil certainly will be one of them. But it's a tough play. It's not a clean pattern like GLD, which if you look back over the last 11 years, you can see some very clear buy points, pocket pivot buy points, and the success rate's enormously high.
Yeah, and other than that, where are the other ones? Concho Resources. Just make sure you don't get stuck in something like this, because this was looking okay a few days ago, and then bonk, it gets clocked. So I do notice you see these, here's U.S. Steel, you see these sort of bottom fishing pocket pivots occurring. I think you got one here. Actually here, and here, these coming up. So it's starting to round out, but it's still in a premature position to be buying this thing. I notice you see Freeport-McMoRan doing a similar sort of thing. And you've actually seen a lot of some of these beaten up stocks trying to form bottom fishing pocket pivots. So even Netflix, we talked about this last week. This is kind of your bottom fishing pocket pivot. It's a riskier pattern, but that would have worked. You could have bought that. You look at stock like SodaStreams, which was breaking down. Here's a pocket pivot coming up through here. I mean, these are bottom fishers, so they have a lower probability of working. Here's Fossil, and this is kind of like big pocket pivot. I don't want to mess with this on the short side right now, but that shows you the types of moves that you're seeing in stocks coming up off the lows. And there's been a number of these. Let me see. I mean, look, even LinkedIn. Coming off the lows, here's a low, it comes to retest, selling is very light along the lows, and you start to pick up a little pocket pivot-like move here, and comes up out of there. So there's a lot of this going on, but to me it may just speak of slow rebuilding, or that you're getting to a point where there's really no more downside, like I'm talking about with the 94 example. There's no more downside, but it's going to be real choppy and you probably don't get anywhere. But eventually you get to a point where they either wear you out or scare you out, as the old saying goes. And in 1994 they definitely wore everybody out. Could it be an environment like that? It's possible. So, but you are seeing a lot of these things start to bounce. Let's see. I was even seeing there's some good typing skills there. This Royal Caribbean, which has been a really ugly stock for a while now, is turning around. You're getting this pocket pivot action in here. Even Rovi, remember Rovi? Good old Rovi. In fact, I pointed this out to you, Dr. K, a few days ago off the lows, and we saw this. I mean, because we're seeing, and I'm just pointing these out because it seemed like there's a confluence of these all of a sudden. And what I think it tells you is, at the very least, you're just at a bottom here and trying to short the market. You're not getting anywhere. I don't know if you necessarily make big money on the long side, but I think you're just beating your head against the wall on the short side right now until something changes. So, you're seeing that. Let's see if I got any others here.
You can also have a junk off the bottom kind of situation like we did numerous times in 2009, because it might be, this rally might be it is partly QE motivated, quantitative easing motivated. So that could be what we're seeing. In other words, so the junk stocks are going to be the ones that are more tradable, but on a swing trade basis. In other words,
and some are junkier than others. I think I like CF. I like this actually. You're showing AMPs here up 12 out of 15 days or better here. So I actually bought this on the pullback earlier. and see if this thing gets out of here. But I noticed that the fertilizers are suddenly very strong, and that goes, pot is probably the doggiest one here. But it's trying to come up off the lows. Agrion is coming up off the lows. Even IPI is trying to come up off the lows. But so you're seeing some of these turn. I think this is probably in a better position. We'll see if these work. But this, this could head up through 170. It looks like it's trying to, and certainly doesn't want to come down. So I even think you play this one with a stop at this low, if you want it, or the low of today, because it held that low pretty well this morning, even with the market down big. And I thought that was pretty constructive. So you're seeing a lot of these things just slowly starting to rebuild, and then confirming that, the machinery. Caterpillar here is a little kind of gap up move, and it's like, and even this right here above the 200-day, that's a pocket pivot, but very, very subtle, very subtle. In here, these are all pocket pivot type signatures, but you're extended from any moving average. But notice how now you're getting at 13 out of 15 days up in a row. So a lot of these bigger stocks have steadily been moving higher. So money is just flowing into these things right now. And whether that's going to sustain a bull move here is remains to be seen. But it is very interesting to see. You can just see things percolating. So, but while we like stuff stocks look okay. Oils are like Dr. K said. I don't like trading oils. People want to know what you think about copper. What do you think about copper? I think the color. I don't really like the color of copper. I know some people have copper roofs around where I live, and I think they're kind of ugly. But other than that, copper is kind of an ugly metal to me. Dr. K, what are your thoughts on copper?
Geez, it's not something that is on my radar at all. So
I know I'm being obnoxious. Yeah, I don't know. I'm not buying copper.
I like the way silver and platinum. Those are my preference metals, actually, but not in terms of investing in right now.
Right, but you're seeing commodities in general starting to rally, and that includes oil has been coming up, and the DBC a little bit better, but nothing really spectacular there. But it's just FCX, big copper play, and they're slowly coming up. What's the symbol? What is the symbol for copper? I think it's HG.
CU.
Copper futures. Yeah, copper slowly moving up. It looks like FCX kind of more than anything. So. But I'd say commodities, the real message in commodities, it really is that maybe you're starting to see this next round of QE, and the market's not going to sell off because it knows it's coming. But at the same time, it doesn't really have any impetus for any major upside. So in the meantime, it's just going to be a slow boat to China. Is Netflix shortable again? No, I wouldn't touch Netflix. Somebody's talking about cores forming potential IPO base. Whatever it is, I guess you could watch it. There's a couple of them. There's some other ones that are forming bases. I wouldn't call it a thick trader. It's a pretty thin trader. Looks to me like the average is somewhere around a couple 300,000. I don't know right now, but it's a little bit skewed because of the first day. So I don't know if I would call it a thick trader.
Although since it's an IPO, what could happen is as the funds jump on, it could become a bit more liquid. If it's really legitimate stock, what you sometimes see is a lot of funds jump on over ensuing weeks, and you get all these high volume spikes, and the stock will just keep moving higher. But that should be preceded by some sort of constructive action, and typically a pocket pivot of some sort before it makes that kind of move. So it's probably worth keeping on your radar.
Mm-hmm. Somebody asking about Biogen. Was Biogen a pocket pivot? No, it's extended from the 10-day. The last pocket pivot you had is right here, so I think we told you guys about that. And there was another one in here, I believe, somewhere. I forget. They were tiny, though, maybe this one. But, they're all marginal. These guys come out with earnings pretty soon, so it's probably going to be some movement based on where they are with their drug for multiple sclerosis. So let's see. What other stocks are we looking at here? Anything exciting? Not really. I mean, you look at Apple. Apple's basically doing what it did last time. It came straight up off the bottom back in June, July of last year. Remember, it came out of this base and launched new highs. And here you go, come out of this base and launch new highs. They come out with earnings next week. I don't know. If you want to game it, go for it. But I don't know. I'm not going to buy this stock straight up off the bottom. But we'll see what the earnings look like next week, and maybe that's a driver for the market. But who knows? You're still in this kind of funky choppy environment. So when you're 200% invested, how many stocks would you own? Two. I remember in 2004 I was 200% invested. 100% was Apple, 100% was Google. What constitutes leading stocks Dr. K uses for his market direction model? Do you include the smaller high growth stocks such as Lulu, or just the big caps like Apple?
No, that's a whole all caps, all caps. Well, not the micros generally, but we're talking high quality small caps all the way up to the super caps. So that would include stocks like Lulu, naturally, and DLTR, CMG, and so on. And of course, there's no industry group that's restricted. It's just I want to get a sense of where the leadership is, where the high quality, fundamentally high quality leadership is in the market. And so the list is dynamic and can change on a day-to-day basis. But there obviously certain stocks will fall off and certain stocks will be added, and it's more on probably a week-to-week basis that there's any material change in the list.
I like this comment. Hey Gil, it's snowing outside. Should I put on a jacket? I think that's a sarcastic remark about dumb questions. Okay. Nice sense of humor. Dick's Sporting Goods. Another gap up like Lulu up to the top of the base. So, I don't know. We didn't put this one on. Why didn't we put this one on? It doesn't excite us as much. I don't know. These are crazy moves. I don't know if I'm going to buy those. Market close on Monday. Somebody asking that question. When will the website update through December 2011 for the TNA stats for the MDM?
Say that again?
When will you update the stats through December 2011 for the TNA and the market direction model?
Through December 2011 for, well, all the tables should be all up to date. When the model switches, then it gets changed. There's a graphic that's just a representative graphic of how the model did using TYH, and it's just purely for illustrative purposes how one can get a sense of the rhythm of the model and how there might be a lot of false signals, but the true signals more than make up for the losses in the false signals. So it's just a purely visual example of how the model works, and it covers, I think, a good 15 months or something. So it seems it's a long it covers enough period in the general market to be, I think, instructive. And actually, there was a question we had from, I think it was a prior webinar. We weren't able to get to it, but they wanted me to talk about 2007 and how it related to the market direction model, since there were a lot of false signals in 2007. And 2007 was the year where the market kept having a string of distribution days, which would put the model into a sell signal. But the market rather would then start rallying again before the model had much chance to capture any gains to the downside. So I believe only one of the model's sell signals in 2007 was profitable that year. So if you grouped all the sell signals, only one of these sell signals was profitable. And I got to say, fortunately, 2007 is the only year where I've observed to have such persistent multi-month volume aberrations, where you have these clusters of distribution days which don't amount to any downside. And I think the volume aberrations in 2007 were due to that year being a transition year, as commodities and leading stocks were forming stealth tops into 2008. So in other words, there was distribution going on even though the major market averages continued to move higher. And it wasn't until late 2007 that the averages did actually peak.
Somebody's asking about Nuance. So what is there to think? I mean, it broke out, and so you had a buy point here on the breakout. There were no real pocket pivots. This was a pocket pivot, but it was extended from the 10-day. You could have bought that, I guess. But it's a thinner stock. I don't really like it, and I'm not really that impressed with the product. That's my opinion, so I don't really mess with it. But it broke out in its holdings. There's nothing else to think about. Somebody says thoughts on Novelis. Thoughts on Novelis. I don't know. It keeps going higher. What other thoughts are there? But it's not like it's a big leading stock. It's trying to turn up out of this big ugly pattern and come up through 42 levels. It's just barely starting to poke out. So, but I don't know. It doesn't have the kind of characteristics I'm looking for. NSR. What is the definition of a pocket pivot? Just go on the website and look at the facts. New Star. Well, I don't know. Here's is that a pocket pivot? You got a pocket pivot right there, but it's acting okay. But it's a teeny tiny little stock, so it doesn't really hit my radar screen. Dr. K, did any of these hit your radar screen?
Well, yeah, I mean, in a better market environment, I might be more prone to recommend, or write some kind of actionable report on a stock like NSR. You got a fairly tight pattern and all, but I mean, in this market environment, I really am more comfortable with more liquid names, because this market is very unkind to non-institutional quality types of stocks. What I mean is institutional focus favorites. I mean, NSR wouldn't be categorized as that.
Yeah.
But it looks good. I mean, the fundamentals, everything looks good about this stock. It's just not good enough. That's the problem in this.
Right, and it's kind of like Stamp yesterday. Ross pointed this one out to me on the pocket pivot up through here. I mean, yeah, it's a really thin stock. But yeah, but we don't, it doesn't really seem like something we want to play, especially in this environment. I think probably INBN is probably as small as we get. But here's somebody asking another question. Thoughts around how to trade around earnings period. I mean, for those of you who've been with us for a while, we've gone over this one time and time again. And there's no magic way to trade around earnings period to reduce or eliminate risk. The only thing you can do is cut your position down if you want, and figure out what you're willing to survive or sit through if the thing breaks 20%. Okay, so there's nothing. If you have a stock, you have a big cushion on it, then you're okay going into earnings. But I think that if you don't, and you're buying a stock right into earnings, and you have to assess, if I take a 10% position, it goes down 20%, it's going to cost me 2% to my portfolio. To me, that's very tolerable. If I take a 20% position and it goes down 20%, it's going to cost me 4% to my portfolio. I can stomach that as well. Maybe you can't. So that's how you would think about it. But I know people always want to know if there's a magic way to prevent from getting hit on earnings. I know there's no magic way to prevent from getting hit on earnings any more than there's a magic way to ensure that you can buy a stock going into earnings and it's going to gap up and go higher. Broad vision is not something I'm really looking at. It trades less than 100,000 shares on average. So I know it's got something going on. Everybody loves it. Go for it. I'm not really playing too thin. I can go in there and drive it up another 5 points for you if you want me to. Or maybe I could short it down 5 points. I don't know. It looks pretty thin to me. Well, let's see. Dr. K, the person asked a question about the TNA stats, says that the last TNA table entry is 12/2/2011 for a buy signal. Maybe you want to look again.
All right, let me check this out.
Is he doubting you? He's doubting you.
Well, hey, you know what? I like it when someone says there's something wrong with the website, because if there is, it's got to get corrected, and we would maybe be unaware of it unless someone points it out. So let me see here.
Anyways, let's see. I'm pretty much gotten through all the questions.
Anyways. And if there's something wrong with it, it'll get fixed.
Okay, Ravens win the Super Bowl. Who? The Ravens. What are they? Is that a team? No, I think the LA Rams are going to win the Super Bowl. Does anybody really pay attention to the Super Bowl? Dr. K, do you pay attention? Do they pay attention to the Super Bowl out there in Europe? No.
No, none. They pay attention to soccer. Soccer is the big thing, and they call soccer football out here, and that's like the whole world pays attention to soccer, and the U.S. is kind of the odd man out. Where
right.
I guess we have soccer teams, but it's not like the end all be all. Or baseball. Baseball's the big thing, I guess.
Right. Right now, I'm not really watching.
I'm just looking at the tables, and whoever's looking at this, first of all, you have to be a subscriber. But if you're looking at it, you're going to see that the model is on cash, and the last entry for all the tables is 12/27/2011. So it's December 27th, and the signal is cash, and that's the most recent model move. So everything looks fine. If you're not signed into the site, it's going to give you a 1 month delay, and that's why you're not going to see
Right, that's what he's saying. So you got to sign in. Okay. Okay, let's see any more questions before we sign off here. We got a few minutes left. Where is the next love coming from? Well, I don't know. Q-Core's giving me some love today. So is Alexion coming back off the lows, looking good to me. I mean, there's some love. I know one thing, the shorts didn't give me love, and Fossil kicked me in the butt yesterday, so, you know. But hey, that's telling me something, so I'm happy to get the message. But there's really nothing, the big breaks in Netflix and Green Mountain earlier, those are your big short plays. And so they came and went. And my guess is they're probably gone for now. Because I don't see anything else setting up. I mean, if somebody's asking, can I short VMware today? I wouldn't. One thing I noted about it earlier, I was telling my trader this, is like, yeah, you short this thing on the opening, you get a buck on the downside. Okay, flip it. And then go long, because it's probably turning back to the upside. Now, you got a long weekend coming up. Is everybody afraid of? Are we trading heavier? We're trading lighter volume today, aren't we?
Last I looked, it was about even, but possibly by now lighter volume.
Probably petering out. Let's see. Where do I count mine? NYSE volume is up 2.6%. Nasdaq's up 3.5. I bet you that tones down, but I'm going to guess that you're going to see the selling kind of dissipate. The market's in a position where it should try to pull back here. Let's go all the way up on my NASDAQ chart back to the present. Whoa, where did that go? There we are. And, it could back and fill in here for a little bit. So it's actually holding up pretty well. Let's make this bigger. Whoops. On the day here. And, you're basically doing this. You're just holding tight sideways. You're up off the lows of the day on the range. Daily trading range, and you're holding up. It doesn't want to come off. And I notice that's the frustrating thing about trying to be short here, is that the things, they start coming off, but you get 2 or 3% on the downside, and if you're playing heavy positions, yeah, you can score 5-10% real quick, but you give it back right away when everything snaps the other way, and that's what's happening. So you're really holding up pretty nicely. So I think it may still be some time. This market is a big yawn. In a way, yeah, it is. And that's pretty much the story. So, there's areas I think you just have to be opportunistic and buy on little pullbacks in here, because I think you're probably going to try and go higher. That's what it looks like. That's what it feels like. I could be wrong, but I can tell you that the signals seem to be piling up in terms of getting more constructive. It may continue to take some time, but we'll see. But that's kind of where you're at. And just watch for the pocket pivots. Some work, some don't. There was somebody who emailed us and said, I bought 7 of the last how many pocket pivots we put out, and he's up on all of them and wants to know what he should do. Well, I think you just kind of hang tight and see how things pan out. Maintain your stops. What would you do, Dr. If you bought 7 pocket pivots and they were all working for you and you were up on them? What would you do?
Yeah, well, it comes, again, 30,000-foot view is that even if you're a trendless environment, maybe 1 out of those 7 stocks is going to keep going. It's going to buck the trend even if the market doesn't continue higher. And that might make all the difference in your portfolio, especially if it's a doubler or a tripler. And those, if you have six names that actually fall back and you have to sell them out either at, I guess a small profit or break even, so what? That's the way, it's a numbers game, and that's the way it goes. But that 7th stock that you sit on can make all the difference.
Yeah.
So I would stick to your rules regardless of, it's very tempting, I know, to want to change your sell rules or or sell into strength, or sell, to take profits off the table when the market has been as challenging as it's been since January of 2011, and the temptation just keeps growing. But in my experience, it's just best to stick with what stick with your rules. In 1999, October was a great illustration of that. Actually, October of 1998. When people were shorting the market, that was after the NASDAQ had corrected something like 36%, peak to trough, and people were really they got sick of the year. A lot of people were down by then for 1998, and October was one of the most powerful, explosive periods of high-quality names setting up excellent bases. So I went from 0 to 200% long in just a matter of days. And made all the difference. In fact, that 4th quarter is probably my best quarter in my trading career.
All right, so there you have it. So that's where we're at, you guys. So we'll just see where things kind of pan out right now. We're not, 100% enamored with the market environment just yet, but it's kind of a yawner. But remember, it'll wear you out or scare you out. My guess, this one's trying to wear you out. And when you're yawning the widest and paying the least attention is probably when the thing starts to go. So anyways, we'll catch you next time, everybody. Thanks for listening, and have a good one. Good luck.